Welcome to the UAE IFRS module on liability and equity classification. In this session, we'll break down how IFRS definitions apply in the UAE, supported by real-life examples of accounting entries for both liabilities and equity. We'll explore how corporate tax law interacts with IFRS rules, what this means for provisions, capital liabilities, and equity instruments, and finally, we'll wrap up with practical guidance to ensure audit readiness and compliance. By the end, you'll not just know the definitions, you'll be able to apply them in journal entries used in UAE businesses. In the UAE, IFRS is mandatory for financial reporting under both the Commercial Companies Law and Corporate Tax Law. IAS 32 and the IFRS Conceptual Framework determine whether an item is classified as a liability or equity. For example, a bank loan is recorded as a liability because it represents an obligation to repay cash, while issued share capital represents ownership and is recorded in equity. Getting this classification correct is essential because your trial balance directly feeds both financial reporting and corporate tax returns. A liability under IFRS is a present obligation from a past event that will lead to an outflow of resources. Examples include trade payables, bank loans, and provisions such as warranty obligations. In the UAE, distinguishing between capital and revenue liabilities matters for tax. Capital liabilities like loans do not affect taxable income, while revenue liabilities like accrued expenses do. For example, if a company receives goods on credit, the entry is debit inventory, credit accounts payable. If it records a warranty provision, the entry is debit warranty expense, credit provision for warranty. Each of these has different tax implications under UAE corporate tax law. Equity represents ownership interest in the company. Typical UAE balance sheets include share capital, share premium, retained earnings, and reserves. For example, when new shares are issued, the entry is debit cash, credit share capital, and credit share premium if issued above par. Under IFRS, certain preference shares must be treated as liabilities instead of equity, depending on repayment terms. Non-controlling interests must also be disclosed separately so stakeholders can see what portion of equity is owned by minority stakeholders. In UAE corporate tax, the classification of liabilities and equity directly influences taxable income. For example, interest on loans is generally deductible if conditions are met, while dividend distributions are not. Ministerial Decision 134 of 2023 allows a realization basis election for certain capital account liabilities. So gains and losses are taxed when realized, not accrued. For instance, if a company revalues a long-term liability at year-end, the accounting entry may show a gain, but tax rules may defer recognition until actual settlement. Misclassification here can lead to compliance issues and penalties. In summary, UAE companies must apply IFRS definitions to liabilities and equity, as required by law. The classification of a loan versus equity impacts not only financial reporting, but also tax reporting and audit readiness. Always ensure provisions, capital liabilities, and complex instruments are disclosed transparently. For example, a simple loan repayment is debit loan payable, credit cash, but failing to classify that loan correctly as a liability instead of equity could distort both financial ratios and tax compliance. Consistency in applying IFRS or IFRS for SMEs is essential to maintain comparability and credibility.